Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television. We continue with our special series of Market Masters to get you to meet professionals who have navigated a variety of bull and bear markets, rising volatility, falling FI participation, increasing interest rates, falling interest rates over a period of time, and have made a lot of money for their unit holders. It's a pleasure to welcome Mr. Mihir Vora, Chief Investment Officer at Trust Mutual Fund, a person who has been in the markets for the last 30 years, has worked with many AMCs and is now the top man at Trust Mutual Fund, where he manages amongst many other schemes, two major equity platforms, the FlexiCap fund and the small cap fund. Trust Mutual Fund also offers money market instruments, but that's a different story altogether. We'll focus on equities. Namaste Mihir ji, and a very warm welcome. Is the new high coming on Dalal Street fairly soon? Last Friday, RBI increased the cut by 50 basis points and also reduced CRR by 100 basis points in liquidity being injected into the market.
Yes, hi Shailendra. See, the point is that it's not only India, but globally, central banks are, on an easing mode. We've seen quite a flurry of cuts in the last 6 months across central banks. Last week, while the RBI also cut rates, we saw the European central banks also, cut rates by 25 basis points. So I think financial conditions in India as well as globally are, turning loose. And which is always good for risk assets. So I would not be surprised if the Nifty, crosses a new high because conditions are right. Result season has been good. We saw good results, okay results in large cap, but good results in some of the mid cap index stocks. So I think the only thing missing is very strong traction on the urban consumption side. Otherwise, government spending is fine, liquidity is fine, monetary conditions are fine, and there is a bit of a global tailwind also building up as far as risk assets are concerned.
Okay. What we'll do here is that we'll focus on the global part of the market in the latter half of the show. Let's just discuss the two important funds that you manage. The Trust FlexiCap fund that was set up in April 2024. We are celebrating its 14th month of existence. Return has been 15% CAGR, and it's a large cap heavy fund whose details will now be in front of you as far as top holdings are concerned and other details. Mihir, how do you see the banking space now, given that liquidity has come up sharply, rate cuts are in place, and in the top 10 stocks that you hold in the FlexiCap space, there are three private sector banks, one SBI, and a little lower you have several other banks also.
Certainly. So definitely, easing of liquidity conditions and lower interest rates are in the long term good for the banking system. So we are positive on banks and the lenders in general. However, within financials, so far we have been more positive on the capital marketplace because in the last 3-4 months we did see build up again in the volumes and the sentiment of the stock market. So that's always good for stock market plays and capital market plays like wealth managers, broking, insurance, the exchanges, etc. So we've been quite bullish on that segment. But coming to the lenders, while banks, the I would say the conditions are ripe for a rally in the banking sector. The only thing missing is credit growth. So the bank balance sheets are absolutely clean, very well capitalized, all set for growth. Uh, Same for the public sector banks, private sector and public sector have done a great job of capitalizing and cleaning up the balance sheet in the last 4-5 years. So I think the only thing that is missing is credit growth on the banking system, and with growth coming back, I think that's only a question of time. Valuations have also corrected over the last 1.5 years. So in general, banks look extremely well on the risk return trade-off, provided there is one little growth stimulus, and we are betting on that. So as you can see, we have a good weightage of banks in the portfolio, and that's exactly because of that trigger. Having said that, the rate cut immediately impacts a lot of NBFCs much more positively, but that's in the shorter term, and that's because they are typically wholesale borrowers and their asset book is typically more biased towards fixed income, fixed rate assets. So when your asset book is at a fixed rate and your wholesale borrowing costs come down immediately because of the rate cut, then NBFCs tend to be a little more benefited in the shorter term. So we are playing the banks as well as NBFCs in our portfolio.
Okay, fair point. Yes, there is amongst the top one, of course, Bajaj Finance in the top five, and then a little lower, you have Muthoot Finance as one of your major holdings in the trust FlexiCap fund. So that takes care of the lending part of the business. In fact, if we look at data, Mihir has raised stake in HDFC Bank, ICICI Bank in the latest portfolio that was reported, even in Axis Bank, even in Muthoot Finance, even in SBI. So all five banks and NBFCs represented in the top 10 have seen their stake rising, including Shriram Finance a little lower. So that takes care of the banking space. The other thing, Mihir, that I notice in the small cap fund that you run, as also in the FlexiCap fund, that defense has been on the front foot. Would you want to defend this investment theory, given the fact that May has seen a very sharp run up in stocks like Mazgaon Dock, Cochin Shipyard, Garden Reach, so on and so forth? You continue to hold them, you see no reason to book out.
Defense is one segment where we have been bullish all throughout. It's not because of the border incident. Even last year, if you see the portfolio, we have been consistently exposed to these stocks. So these are not new names for most of these are not new names in the portfolio, both for the small cap fund as well as for the flexi cap fund. And if I were to just give you one reason why we are structurally bullish on this segment, it is because of the fact that this is one sector which is actually emerging for the first time. So the fact that private sectors have only recently been allowed in the sector means that the sector's potential had been absolutely underutilized and under-recognized for a very long period of time. And now, because of economic as well as strategic and geopolitical reasons, the government is hell bent and dead serious on making sure that we produce a lot more domestically and roping in the private sector to help out because private sector can take decisions faster and scale up things faster. Plus, the kind of width of technologies and verticals required in this segment is so high that it won't be possible for just the PSUs to do it. So, very clearly, the government wants to ramp up this sector and the government wants private sector participation. So that's something that is happening for the first time. We've seen 3-4 good years, but since it's a young industry, the runway can be very long. That's why we believe that the story can last for a very long period of time. The second is the second point is, which is an offshoot of the first point, is that once you get the private sector in, then you become globally competitive. And we have begun export inquiries coming in, other countries wanting to buy our products and services on the defense side, which is something again which was not happening earlier. So a whole area of exports is opening up, which can be much larger than the domestic market. So I think the runway of growth for this overall piece can be very long.
Okay, let me just take a few names that are there in Mihir's small cap portfolio. So the top holding is Solar Industries. It's done phenomenally well from the private sector and a fabulous defense play. It started out as a manufacturer of explosives for Coal India and has slowly but certainly pivoted towards making defense missiles as also drones. Then you have Hindustan Aeronautics, which is present in the small cap as well as the large cap funds. Bharat Dynamics, that is there as far as the top three holdings are concerned within the defense space. Okay. So it's predominantly, and there was BEL in the FlexiCap fund, if I am right. So this is primarily the top five large caps within the defense space that you hold. Mihir, anything that catches your fancy in the private defense space apart from solar?
So I won't name specific stocks, but if you look at my small cap fund, there is a list of other names also, which is there. May not be the top 5 or 10 holdings, But since we have 60 stocks in the portfolio, there are other names in the fund in the defense space, because the total exposure to defense all put together is in excess of 10-12%.
Okay, fine, fine. Okay. The other,
Some of the names are also being flashed while we were talking.
sorry, I didn't catch that.
Some of the names were also being flashed while we were talking about the
Yes.
different.
Yeah, I see data patterns in your portfolio now. I missed it earlier. Okay, fine. So defense is done, banking and finance you like. The other rally that we are seeing, Mihir, is the return of uh, the wealth management space. You are very well represented by BSE in your portfolio. Again, these are runaway stocks. NSE in turn is about to get listed. All of us know where the unlisted stock price is. What do you think is driving this momentum again at a time when we really don't have weekly expiries any longer? Much of retail participation on a daily basis isn't as high as it was maybe 6 months ago.
Sure. So the point is that things tend to get reset, right? In the sense, the stocks did run up very well last year in 2024. Then from January to March, we saw a correction, and then again, as volumes started happening, the on a low from the lower base, the stocks in the capital market space have started bouncing back. So I think while in the short term these are cyclical factors, and this expiry etc. Does tend to have a short term implication, but the point is that these things tend to get reset, and once the base is reset, again the market start looking at the forward growth rate. So the structural growth triggers, which is more participation, more volumes, better pricing power, etc. I think that continues in that space. Now, whether it's a broking or asset management or wealth management or exchanges and R&T agents, etc. I think that broad theme of higher volumes, more people entering the savings pool, larger savings pool, that is basically the driver for these segments.
Fair point. Okay, that takes care of three segments that we are talking about. You aren't very happy with the software because there isn't much representation in the first place, and wherever we see software stocks in trust mutual fund, they are being trimmed. A view here, Mihir, are we headed for an underperformance in frontline IT stocks? How do you want to play this? There isn't much in terms of mid-cap IT also in your portfolio.
Uh, yes. So within IT, the large caps are actually becoming quite, I would say, mediocre growth stocks. We're talking about single-digit kind of growth, and in a country like India, where the nominal GDP itself is growing at 10-12%, a 6-8-9% growth is frankly not good enough. Having said that, they are good quality businesses generating a lot of cash flow. So to that extent, probably they have the status now which FMC used to have some time back, as a safe defensive segment, I would say. But if we are excited about the market, if we think the market is in uptrend, then I don't think this segment really would outperform. So this is more of a hiding place in volatile times. But if times are good, then probably this segment can underperform. Having said that, if you look at the other names, the mid-cap names, I think there are still many managements and companies in the mid and small cap space within IT, at least 4 or 5 names that I can think of, where the promoters and the management still have that, fire in the belly. And plus, they are small enough to still grow, even in a low growth industry, to still grow at a decent pace, by identifying new products, new services, because the base is low. So I think we would, back those kind of managements and promoters.
Fair point. Uh, any pockets of overvaluation, uh, desperate run-ups that you see in the market, Mihir, which worries you?
I mean, there always are, because, since the markets are back to almost their previous highs, and stocks rallied 30 to 60% from the bottom. A lot of stocks have rallied, 30% to 60, 80% from the bottom. There will be pockets of overvaluation for sure. And what we do is basically we don't trim we don't sell in one shot. We basically trim on the upside and try to, buy on the downside in a staggered fashion.
Okay. And any view that you would have on mid caps and small caps? Those two indices are still far away from all time highs. We see a record peak in Bank Nifty, Fin Nifty. Nifty, you say, is headed that way. Any view that you hold on small caps and mid caps? How do you trade them given that fourth quarter hasn't had many accidents?
In fact, if you look at the mid cap space, the results have been actually quite good. The growth has been quite good compared to large caps. In absolute terms, my belief is that the mid and small cap space still has steam, growth steam left. Valuations is one other aspect, and the fact that the large cap indices are pulling the weight means that mid and small should also start following at some point in time.
Okay, fair point, fair point. Yes, it's a rising rally, so this tide should lift all boats sooner or later. Uh, Mihir, your view on both gold and silver? I mean, you don't run a multi-asset fund. Are you launching one first of all? And silver is now mimicking gold. How do you look at it from that point of view?
So I think we discussed this last time
Yes.
also. I continue to be positive on both the commodities. Basic underlying thesis remains the same, which is that the central banks are willy-nilly going to monetize their way out of the problem, which is too much debt. So with too much debt, the only way you can service this too much debt is by issuing more debt in the future, means more monetization. So I think the debasement of the currency that we see in slow motion will continue, which means that hard assets like gold, silver, real estate should do well.
Okay. I just wanted to understand what is your peer group thinking in terms of Mr. Trump. When he came in, he created this furor about these tariff wars, and they are on. He's now put in a 50% tariff on aluminium within imports within the US. As a fund manager, are you ignoring this volatility now? What is your view on the largest economy in the world? They've again started raising fresh debt. Uh, is that, when you look at US 10-year yield, do you get a little worried?
Yes and no. Yes, because obviously it's not great to have high interest rates. But the point is that on one hand, you are talking about the seriousness of the debt problem, the US is itself, and on the other hand, you are doing nothing about the fiscal deficit. So it's a irrational situation to be in. And when you have this deadly concoction of high fiscal deficit and high debt, as I said, the only way to keep things going is to print more money, and which is what the world is beginning to believe. So the taco trade, as they call it, I think is real because there is no other option.
Okay. Uh, just a view. In the early part of the interview, you mentioned that the entire world is easing up. Given given the inflation 2 months down the line, as far as US is concerned, they're just raising more debt. Look at CDS spreads for US debt, they're worse than Greece. Maybe the Federal Reserve will act to again put down inflation. uh, are we into a global easing cycle according to you?
So I think it's each man for himself. So like country Europe, for example, is in an easing cycle because their fiscal deficit is not that bad, and there is a slowdown there. In US, it may not be that easy because growth is still good. In fact, there has been because of the fiscal deficit and fiscal spending, you are actually seeing upgrades in growth estimates in the US to some extent. So US may not be in an easing cycle, but the rest of the world is. So we have seen a lot of emerging market banks going the easing way. Europe that we mentioned. So it's a mixed bag, but in general, the number of rate cuts has accelerated in the last 3 to 6 months.
Okay, let's keep it at that. Now, when you look at how the local liquidity has eased, let's look at the other side of the table, which is the bond market. How do you see Indian 10-year yield 6 months from now? Is there a chance it will fall below the US 10-year yield? That will be a day.
I don't think so. Our view is that it will trade between 610 to 640. That's the range we are looking at for the next 12 months. Because, I mean, all said and done, we are an emerging market and we are running a trade deficit. So we can't get things too loose beyond a point. So while the RBI does expect inflation to come to 3.5, 3.7% by the end of the year, which means that even if you have some 1 to 2% real interest rates, you can't really go below 5.5, so to say, on the repo rate side. And with repo rate at 5.5, I think 610 to 640 10-year bond yield looks fine.
Okay, fair point. And when you look at the actual business, when you look at the actual quick indicators on a monthly basis, Mihir, are you getting a feeling that the economy is gathering steam, given the GST numbers that you see? What's your gut feel about the underlying economy? Of course, markets are now running up because of liquidity, but how much of this rally can be attributed to genuine economic growth?
So from the indicators, I get the feeling that the rural economy is coming back. For example, anecdotally, if you see the numbers, two-wheeler sales are accelerating, but cars are not yet accelerating.
Yes.
So urban is still a question mark. In fact, urban was doing well till last year. It's probably slowing down a bit compared to last year. But on the other hand, rural is picking up. So you kind of have a offsetting influence there. Government spending is doing well. If you look at the March numbers for government spending, they were up significantly on a year-on-year basis. And private sector investment, I think, is still coming back in a slow fashion. Real estate sales are doing well. So, I think it's a mixed bag. And the hope is that with, the continuing government push and the RBI push on interest rates and liquidity, the rate of pickup of growth should increase now.
Okay, fair point. FMCG you still don't like. There's no presence in the portfolio.
Very little, yes. Again, it's a single-digit growth kind of environment, and we want double-digit growth in most of the stocks that we own. We are growth investors.
Yes, I understand. But given the fourth quarter earnings that have now behind us, what were the remarkable standouts for your research team within your own portfolio? What really caught your attention?
So I think the second half of the season was a bit more positive, where a lot of mid-caps actually surprised on the positive side, both on the margin side as well as on the top line side. Banks were as per expectations, the financials were more or less as per expectations, but a lot of the mid-caps did surprise on the positive side, on the top line.
There has been some talk, Mihir, in the market about the rupee. It was the best performer, the second best performer in the month of May versus the dollar, second only to the Turkish lira. Do you think the real exchange rate is now in front of us? Do you see any pain points in the coming 6 months or so versus the rupee?
No, I think the fact that the dollar is weakening against a lot of currencies is at play here. So while the rupee looks stable, it probably may be appreciating against some of the currencies, I would say, or stable against some of the currencies. So I think globally, as long as the dollar is not going to get very strong, we should be in a good position because relatively, I think we are only appreciating or stable versus the other currencies.
And my final question, will our foreign friends return?
I think they've already stopped selling, which is
Yes.
a good beginning. And hopefully, with the currency remaining stable and our GDP growth rate anyway being the highest in the world, they should come back.
Okay. And ballpark, Mihir, are you now, when you see the markets on a regular basis, are you a little less edgy than what you were somewhere in March? Do you see confidence coming back in stock prices, in trader favorite counters? Do you feel the risk on is back?
I think the risk on is back, though in the last few days the pace of rise has been quite fast. So I would be in the short term be a little cautious, I would say. But I think things are okay in terms of the environment to take risk.
Okay. Thank you so much. What a lovely half an hour with you. Let's hope we see the new high on the Nifty again fairly soon, as also on the Sensex. And here's wishing you best for the second half of calendar 2025. Thank you.
Same to you. Hopefully, we'll talk when the markets are at new highs next time. Yes.
Of course, they will be. That, ladies and gentlemen, was Mr. Mihir Vora, CIO of Trust Mutual Fund. Very, very bullish on the banking space, in particular NBFCs, given that the RBI has cut the repo by 50 basis points and CRR by 100 basis points, is bullish for the long term and medium term on defense counters, many of them in his portfolio, which were obviously purchased much earlier. He hasn't booked any during the last month, May, when these stocks rose up sharply, and he says conditions are ripe for a rally. What is missing is credit growth, and banks should do well. He's also very, very hopeful on NBFCs, and that, ladies and gentlemen, should be reason enough why you should see a record high on the Nifty fairly soon. I hope you enjoyed this conversation as much as I did. Please continue watching Business Today Television. There is a lot that's happening on the other side of this break.
If you like the video, do like, comment, share and subscribe. If you like the video, do like, comment, share and subscribe.